Sam here, and I'll be doing the free video for Friday, November 3rd, 2023. So, a completely standard week is in the books. Very boring, very lack of movement, no trading range whatsoever. Oh, never mind. Actually, that's a gigantic candle. Probably the biggest candle of the year, it looks like, pretty easily. So, very interesting stuff. We had the Fed meeting November 1st, and since then, and even a little bit before then, frankly, since then, shorts have been getting absolutely spanked. Very, very impressively so. So, our job in this video, and it'd be nice if I could maybe talk to you guys a little bit more often than just on a Friday, so we can kind of update you as we go. Which I may work on that. I may work on maybe building out a channel for myself where I can kind of do a daily update with you guys. So maybe comment in the chat if you'd like to see that, or if you can give me a good name for it. I think the one thing that's preventing me from starting a channel here on the YouTube is I don't have a good name for it, right? It would be stocks, squirrels, and one more thing that I'm good at that I can't think of. So if you can think of a good name for my channel, we'll maybe get that started soon, and then we can have some daily updates for you guys. But for now, we gotta take what we get, and we get Friday updates with you, which I'm certainly grateful for. So there's going to be some major changes here to the charts, and we're starting with SPY because we always start with SPY. But the major change, in my opinion, is not SPY. SPY is the tail of the dog. What's really leading the situation is going to be the bond market, right? ZB, or take your choice of whatever bond product you want to look at. So we'll cover that here, but let's start with SPY. So one thing to note here is that SPY has now gotten back into its basically kind of this giant trading range. It had threatened to break down from that trading range very strongly. You had these previous lows here, and you go and you undercut the lows and put a lot of pressure on it. I mean, it spent a lot of days underneath the daily 200. It broke beneath the 50% Fibonacci. It broke below the VWAP for the year. And then, of course, we get a massive candle to the upside on the weekly chart, and that starts to reverse things. So one thing that was very necessary here to reverse this structure was you needed to see thrust from the high-low, which you currently do have. Now, I'm not going to spend too much time on this because I do want to spend a little bit more time on what I think is really what's driving this. But one thing to note is just you've gotten over a lot of key levels, right? You've gotten back above your 618. You had some previous swing highs here at 432. You got back above the 200. You're back above the 21. You're back above the 50. Right? You're back above VWAP. So you pretty much in 1 week have recaptured almost every structural level. And then you got to ask yourself, well, where are the shorts? Where's their last stand? And I would say probably 440, right? I think we can make a pretty good case for that. One, you have an open gap here. It's not open really, but it is a gap. And then two, you can see that when they failed to get through on those candles, you flush below. So it's actually a little bit right below 430. Let's call it 438, I think is more accurate. But if in the next 2 weeks or so, they can start pushing this above 438, you'll have a potential here for an actual big run into the end of the year. So the question is, do I cover seasonality here or do I cover it at the end? I'll just throw it in now. So seasonality, the best seasonality of the year, meaning that the best 2-month period of the year is basically kicking off now, right? It basically goes from November, the beginning of November, to the end of December. So here's the case for that going into the end of the year. So let's jump over to bonds, where I think is really what is driving a lot of this. So bonds have been just the most consistent thing to sell ever, right? You can see that as basically what I was telling the folks in the premium video is the most important thing in the stock market long term, short term, this will apply today, this will apply 1,000 years from now, is the price of money, right? The price of money is everything. And the example that I use, and it just so happens I caught COVID going to Orlando, which is fantastic, so I'll give you a COVID analogy. If you go back to 2019, if somebody would have told you at the beginning of 2019 that a global virus would cause every country in the world, except for Sweden, to basically shut down and everybody would stop working for months or longer, what would that do to the stock market? Most people would say that it would drill to the zero, basically, because there would be no economy to support any kind of commerce. But what did the stock market end up doing? The stock market ended up almost doubling, right? So they shut down the entire world, and the stock market almost doubled. Why is that? How does that logically make sense? That there's no economy, no commerce, and the stock market doubles. Well, one, the stock market is not the economy. Very important distinction. Two, the price of money. When they shut down every country, what did they do? They started sending out checks to everyone. You know, my mom's cat got a check. Don't tell the IRS. So they sent checks to everybody. They printed more money than has ever been printed, and rates were basically at zero. Europe went negative, right? So the quantity of money went historically through the roof, parabolically. The price of money, the cost of money in the form of interest rates, went down parabolically to zero, and the stock market doubled. So that's all that drives markets, in my opinion, right? Is the cost of money, the price of money, and the dynamics around that. So as you see this chart here on ZB, that is the price of money going pretty much exponentially higher, which is not good for stocks. What I'm going to present here, the case that I will make, is that we have probably seen the low in ZB and the top in rates for now. Huge volume, very important. You can see that when the squeeze triggered here in, let's call it June or July, you see your red bars, red, all the way down, stair stepping. This is your first yellow bar in, however many months that is. This is also your first time, conclusively breaking above the 21 in a long time. So the dynamic here is that as long as bonds continue going higher, or basically even if they just stop falling, right? Even if we do something like this and kind of just meander and hang out in the box and just kind of chop around, make a mess of it, even that will be positive for stocks, because the one thing that can break stocks is not what's going on in the Middle East, right? What's going on in the Middle East is a tragedy, but it is not overly relevant to the price of to the movement of it. It's not. It doesn't. One second. Excuse me. The COVID is kicking in. I've been talking too much. What's going on in the Middle East is not more relevant than the price of money, right? If you could choose between the entire Middle East being obliterated and low interest rates, or the entire Middle East finding peace for the first time ever, and everyone loving each other and hugging each other, and high interest rates, and you wanted to make a decision that is only good or bad for your portfolio, you would go with the obliteration and low interest rates. And it sounds mean to say, but that's just the game we play. So I say this to you because we get this question a lot in the room, and frankly we shouldn't. News does not matter, right? News only matters in the shadow of the price of money. If the price of money is cheap and the quantity is plentiful, then stocks are going to rally. And basically this is a bond rally that you're seeing manifest in stocks. I'll give you one example and then we'll take a look at the dollar here. So check out this candle here on HYG. This is junk bonds. That is a formidable candle. Now mind you, this product this isn't Tesla, this isn't Nvidia. This doesn't normally have this level of volatility to the upside like this. This is a gigantic candle in junk bonds. Why did we have such a big candle here in junk bonds? Because mechanically speaking, everyone and their cat is short bonds, right? And they're off sides. So if you have the question of how do interest rates come down, well, mechanically speaking, as long as folks are this short, they're going to be forced to buy bonds, which would push interest rates lower. And you're certainly seeing that in something like HYG. So then let's kind of round it all out here, and then I'll put all the pieces together for you at the end. So let's close out with the dollar here. Now the dollar is just basically a derivative of bonds, right? In my world, bonds matter way more than the dollar, but they're not, they're not unlinked, right? One is linked to the other, but if I have to choose only one thing to follow, it would be bonds. But you want to see them kind of play together in the most ideal situations. So the dollar here, we've had this level here at 105.38 for a very long time, and you're kind of making this basing pattern. You could have argued kind of a flag pattern. The indicator wasn't loving it. You can see you've had 3 sell signals there inside of that flagging pattern. And as of today, you broke structure completely. You broke the 21, you broke the 50, and you broke this key level of support here at 105.38. Excuse me. My mute button doesn't work. I don't mean to cough in your ear. And so what do we have now? Well, we've broken 105.38. We still have a squeeze in play, and we now have 3 sell signals inside of that range. And we have kind of a crowded trade. Everyone, I think, is long the dollar. So if bonds continue higher, that's going to be good for stocks. If the dollar continues lower because bonds are going higher, that will be good for stocks. If seasonality kicks in, that will be good for stocks, right? Mechanical positioning, I'm going to put MP, indicates that a lot of folks are still short, and that would be good for stocks. So going into next week, just to put all the pieces together, this week created a hell of a trap, thanks to Powell, in the bond market that has led to a potential major reversal in bonds, leading to a reversal in the dollar, leading to a major reversal in the indexes, buoyed by a strong seasonality into the end of the year, and you have mechanical positioning of everyone being short. So if there was a perfect recipe to create kind of that end of year rally, I think we just covered it. So can we see that? Absolutely. Do I want to chase the action on Monday because I'm just so screaming bullish here? Absolutely not. We've seen a very, very strong week. It's the biggest week of the year, I believe. And the answer is always found in the pullback, right? If we wake up on Monday and you don't see intraday support levels like the hourly 21 start to hold, then that's going to be a big problem and would lead to some pause. But I think we make a pretty good case based on those 5 points that we just talked about that the setup is there. So we would look for a pullback to hold, and then we would look for the end of year rally. Once we get to the end of the year, we'll have a different discussion. We might even have a different discussion next Friday. I won't see you guys for a week. But as it sits here going into next week, that's the lay of the land. The way to play it is going to be, in my opinion, through tech. However, if you understand the 5 points that I'm putting down there, and go back and rewatch the video if you missed them, the 5 points I'm putting down, if all of these hit, then you can pretty much buy anything. And it all should work, but tech should be the easiest. All right, guys, I got to go rest my voice. The COVID is kicking my ass. Thanks for watching the video. We always appreciate you guys. Leave us a comment down below, especially if you can give me a name for my channel. If I use your name, I'll certainly go out of my way to send you a little prize or something. I'll contact you on YouTube. So, and also I'll give a special shout out to whoever gives the funniest name. So leave us a comment down below. It helps us out with the algorithm. So if you don't have anything to say, just let me know what you're having for dinner tonight, and it'll still help us out with the algorithm. Leave us a like, and I'll catch you next week for next week's video. Cheers. Hey traders, this is Sam with Simpler Trading. I want to thank you for watching today's video. Hopefully you found the information in it helpful. If you did, leave us a like, leave us a comment. It really does help us out with the algorithm. And if you want to see us trade live with our own real money and be part of the community, come and check us out at simplertrading.com.